Most people hear the word tokenization and immediately think crypto, price charts, speculation, volatility, but tokenization has very little to do with that. At its core, tokenization is about how ownership works, and more importantly, how it doesn't work very well right now. And once you understand that, the question stops being, why would anyone tokenize their assets? It becomes, why wouldn't you? In this video, I want to walk you through why people tokenize assets, what actually improves when they do, where the real value comes from, and just as importantly, when tokenization doesn't make sense at all. This isn't hype, it's infrastructure. Let's start with the problem. Most valuable assets today are illiquid, slow, and rigid. Real estate, private equity, private credit, even things like revenue streams or intellectual property. They're valuable, but they're stuck. If you want liquidity, you usually have two choices: sell the whole thing or borrow against it. Neither option is flexible. Tokenization introduces a third option. It allows ownership to be split, structured, and transferred with far more precision. Not faster trading for its own sake, but better control. And that's the first thing people misunderstand. Tokenization doesn't magically increase the value of an asset. It increases the efficiency of owning it. That difference matters. One of the strongest reasons people tokenize assets is liquidity, but not the kind of liquidity that encourages constant trading. Tokenization allows partial liquidity. You don't sell the building, you don't exit the fund, you don't give up long-term exposure. You just unlock part of the value. That changes how asset owners think about retirement planning, capital recycling, diversification, and long-term risk management. Instead of being forced into all or nothing decisions, ownership becomes modular. That's a quiet but profound shift. It's the difference between owning something rigid and owning something adaptable. Fractional ownership often gets dismissed as a gimmick. But the truth is, fractional ownership has existed for decades. REITs, funds, syndicates. The difference with tokenization isn't the concept, it's the granularity. Tokenized structures can offer smaller minimum investments, clear ownership records, transparent cash flows, defined rights encoded from day one. You're no longer relying on layers of intermediaries to tell you what you own. Ownership becomes explicit. And when ownership is explicit, trust requirements drop. That's why real estate has become such a natural fit for tokenization. It's familiar but badly constrained by legacy systems. Here's where things get interesting. Tokenized assets don't just represent ownership, they can enforce it. Income distribution can be automated. Voting rights can be embedded. Transfer rules can be predefined, not through paperwork, through logic. This is what people mean when they talk about programmable finance. And it's already influencing traditional systems, even when they don't admit it. When settlement happens faster, compliance becomes cleaner, and ownership data is always current. Entire back office processes start to look outdated. Tokenization doesn't replace finance. It quietly forces finance to evolve. Now let's talk about the mistakes. Tokenization isn't automatically better. Bad structure plus a blockchain is still bad structure. Legal design matters more than the technology. Jurisdiction matters more than the token standard. Platform quality matter more than marketing. If you tokenize without clarity, you don't get innovation, you get complexity. This is why serious investors focus less on buzzwords and more on how ownership is defined, how rights are enforced, how risks are disclosed. Tokenization is a tool, and like any tool, it can be used well or badly. So who does tokenization really make sense for? It's not ideal for short-term flippers. It is ideal for long-term asset holders, people planning liquidity. Years ahead, investors who value transparency, asset owners who want optionality. Tokenization shines when you think in systems, not trades. When ownership becomes something you design, not something you're stuck with. Tokenization isn't about replacing ownership. It's about upgrading it, making it more flexible, more transparent, more aligned with how modern capital actually moves. We're still early. The rails are still being built, but the direction is clear. Ownership is becoming programmable, divisible, and global by default. If you want a deeper written breakdown, I've linked the full article on tokenized living below. And if you want to understand where tokenization is heading next, not just what it is, subscribe, because this shift isn't slowing down.